Hello and welcome to Macro Matters, the economics and politics podcast from Aberdeen Standard Investments. My name is Paul Diggle, and along with my co-host Stephanie Kelly, we're guiding you through the macroeconomic and political themes which are driving global markets. And this week we are talking about bond markets. We're going to try to understand the rise in global bond yields that's occurred since the start of the year, why it's happened, what it says about and means for the economic and market outlook, and what central banks are saying and doing about the increase in the interest rate on government bonds. And this is absolutely a crucial topic of investor and central bank and economist debate at the moment. It intersects with a lot of topics that we've previously talked about on the podcast, including the inflation outlook, the paradigm shift in monetary policy. And it's something that we on the economics team at Aberdeen Standard Investments are asked about constantly. So I'm delighted to be joined by Luke Bartholomew, our senior monetary economist, who's a familiar voice on the podcast, and himself is actually previously a bond fund manager, and Ross Hutchison, an investment director in our global rates team, and someone who is really at the coalface of government bond markets. So Ross, let's start with you. Why don't we summarize what the bond market moves so far in 2021 have been? What has happened in bond markets? How big are these moves? And what's it done to things like the shape of the yield curve and the other features of government bond markets, which you as an investor really care about?
Well, absolutely. And firstly, I just say thank you very much for inviting me on. It is a pleasure to discuss these very topical issues with you all. In terms of bond moves specifically, I'm sure people will be unsurprised to hear there have been pretty significant moves in markets year to date. But last year, was a pretty volatile year in itself for rather obvious reasons. But just to go into the specifics of what we've seen in 2021 is essentially a pretty sharp sell-off in government bonds. Now, when I say that, what I'm referring to is yields have gone up and prices have gone down in these bonds. The investors are demanding additional compensation, essentially, to take the risk of owning these assets on. There's been quite a lot of differentiation in specific markets driving that. So, and I'm sure we'll get into these reasons more specifically as we go along. But just to say, the market that's really been driving this underperformance of bonds, or the sell-off in bonds, has really been the US, where we've seen the largest move year to date in terms of what basis point moves. The US 10-year Treasury is probably the single most referenced asset globally, and it has moved just around 80 basis points, 0.8% higher year to date. It's currently standing at 1.75%. Now, in historical context, this may seem like a pretty low number, and in reality, in a historical context, it is a pretty low number. But within the framework of the COVID pandemic, the extraordinary central bank monetary but also fiscal support that we've seen, and how low these yields were, it's been a pretty sharp and significant sell-off in this market. Just to give some context around that, the recent lows of treasuries, not including some of the real, kind of day-to-day, almost untradeable prices back in the chaos of March, the kind of really tradable lows recently in 10-year treasuries around 50 basis points, kind of beginning of August. And really since then, treasuries have actually been, underperforming and selling off. That's really accelerated at the beginning of this year. Again, there's a variety of reasons for that. And we can see the other global duration bonds, so bunds in Germany, gilts in the UK, have followed the move in terms of the direction has been the same, but this sheer scale of the magnitude has been less. So maybe that's a fairly good summary before I ramble on for too long about that.
That's brilliant, Ross. That's brilliant. Thank you. And these are very important moves. They, as you say, they might seem like small numbers, but relative to the very low starting point of yields, the level reached during the pandemic, they're actually pretty big moves. And that's why they've been such a big topic in financial markets and in conversations and in central bank speeches and so on as well. I thought we could maybe get into some of the details of the breakdown of government bonds, because as economists, as investors in bond markets, we like to look at various breakdowns, like the distinction between the real yield and the break even or the inflation component of yields. That's one important breakdown. Another is between risk neutral yields and term premia. And perhaps a third, not so much a breakdown, but a third aspect of bond markets that we care about a lot is the steepness of the yield curve, the difference in bond yields at different maturities. And some of those moves tell us, I think, interesting things about what's been going on in bond markets. I wonder if you could explain, Ross, for example, how the move has broken down between real yields and inflation break-evens and why that's been important.
Yeah, absolutely. It's been a really interesting thing to observe year to date and, really through all of last year as well. I would say there's a bit of a chronology to how this pricing has evolved. So inflation expectations have broadly been rising from very, very, very weak or low levels since essentially that March-April period when we were at the peak of the sort of chaos of the crisis last year in terms of financial market implications. You tend to see that as break-evens are, or shall we say, the inflation-linked bond universe is a sort of less liquid, less traded asset class and tends to lag considerably behind in nominal market moves. And of course, as well, there's the expectation that when you have expectations of pretty weak growth in the future, as we very obviously did last year, then inflation expectations get hit too. So we got to very, very low levels in inflation expectations, essentially across the globe last year. Now, that's been slowly rising, essentially since the bottoming out. It's, if you chart it, yes, on a kind of month-to-month basis or a day-to-day basis, it does sometimes go up and sometimes go down, but the trend has been pretty consistently up, and especially in the US, that's been the case. We kind of bottomed around expectations in March of 10-year inflation outlook of 55 basis points on average over 10 years, and today we're looking at 235 on average over 10 years. So it's a pretty considerable move in that time period. But even to break down that a little bit more, to go into the nuances of that, the real yields in the Treasury inflation protected security market, the TIPS market, which is essentially the security you buy that is linked to inflation, which means that the yield you're actually buying is a pure real yield. That market had actually been pretty static until really February of this year. So we're talking about a pretty small period. As I said, 10-year treasuries themselves had been selling off and have been selling off, continue to do so. And that, combined with the fact that real yields were basically static, had seen inflation expectations rise through that channel. That is to say, real yields remain the same, nominal yields increase, and the difference is the proxy for your inflation expectation. That started to change in February this year when we began to see pretty sharp increases in real yield component as well. So the 10-year TIP has increased by 45 basis points this year, compared with the US 10-year, which is 80 basis points, as I said previously. But the interesting thing about that breakdown is that relationship was much, much less than just a couple of months ago. So there's an awful lot going on there in terms of pricing. Clearly, inflation expectations are rising, But the next step of this government bond sell-off appears to actually be driven by, more than just that. There is an additional component as well. Real yields, still negative in the US, which has been a historical anomaly, but much less so than they were now, suggesting that expectations for future growth, the fair rate at which investors are compensated for their, real yield exposure is moving higher as well. And I'm sure we'll get onto this. That will also have implications for market pricing, potentially much, much more than just the inflation component would have, as we know the importance of real yields in the framework as well. I'll just touch briefly on the curve, as you mentioned, which I think is a really crucial component. Essentially, and very simplistic, we have seen pretty significant curve steepening across markets this year, really on whatever measure you want to look at. Very short-dated cash to 5-year, very short-dated cash out to 30-year, 5-year to 30-year. Essentially, longer yields have risen by greater extent than front yields have. One of the most obvious reasons for that, I'm sure we'll also get onto this, is that the central banks who really control an awful lot, yes, potentially the entire yield curve, but much more explicitly the front end of the yield curve, have been signaling a high degree of sort of willingness and ability to keep yields low, signaling yields to be policy rates to be low for a considerable period of time. And because that short end of the yield curve is, the best proxy of that pricing, they simply haven't sold off as much. And that expectation is coming into the longer end of the market. Again, it affects different markets in different ways. The US has definitely borne the brunt of that. Europe, where potentially the economic outlook is not nearly as positive, and the central bank is much more active, is still much more concerned about yield increases. We haven't seen as much steepening, but the sign has been the same. We have seen curve steepening essentially in all markets year to date.
Brilliant. Thank you, Ross. So it's really important, I think, to get under the hood of these market moves to understand that it's been initially an increase in the inflation component of bond yields, and more recently a rise in real yields, and also a steepening of the yield curve. The sell-off has been larger at the long end than the short end. We get under the hood of those moves, I think, to understand why all this has happened in the first place, what's driving it, and what it means for financial markets and the economic outlook. So let's get into that question of why. What has changed in the outlook? What have investors had to incorporate this year that they didn't know or incorporate previously to cause these moves in bond yields that we've been speaking about?
Yeah, it's obviously the single most important question, at least in my line of work in bonds. I think we can highlight two specific event developments and then a kind of broader potential intellectual framework or change that has happened in the markets related to these. So I guess in the first instance, last year, the announcement of a vaccine, essentially, and then what became multiple vaccines that were all found in trials to be highly effective, at least in clinical settings, was essentially a green light to the market that there was going to be a potential, sort of light at the end of the tunnel, if you will excuse that awful cliche. That is to say, we can now envisage a world of normalization, of economic reopening, and more so than that, there was a belief that some of the sort of structural features that had been observed because of lockdowns and government responses, namely very high degree of, shall we say, savings on certain consumer balance sheets, would mean that this unlocking could actually lead to a really virtuous cycle, or will lead, in the eyes of some, to a really virtuous cycle of consumption, growth, etc., etc. So that was the first positive development on the economic front. The second is in the political sphere and has clearly to do with the outlook for fiscal policy, specifically in the US. We had the election of Joe Biden, which, although on the very day itself, looked a little bit closer than perhaps pollsters had predicted, eventually we have actually got to the outcome, after the Georgia runoffs earlier this year, where we have a supermajority of one party, the Democratic Party, who now we know both parties are, pretty favorably fiscally, but at least when one party is, in power in all branches, it allows essentially the platform to be delivered, a coherent sort of delivery of fiscal policy. And we have essentially seen that. We already had an agreement last year at the last minute, in the sort of dying light of the previous administration, and we have seen this year another further announcement of considerable fiscal stimulus in the US, and there is an expectation that potentially even tomorrow Biden will be speaking about an additional infrastructure plan for essentially setting out his stall for his vision of his tenure going forward. I think that clearly has the kind of very simple first order effect of suggesting that growth is going to be better than expected because fiscal spending is going to be better than expected, or higher than expected. Some of that fiscal drag that had been anticipated because of congressional essentially wrangling and disagreement had to be taken out of pricing. And then I think we kind of get on to the crux of the intellectual framework, which is we can see an end to this pandemic, where there is potentially strong consumer balance sheets there, but also more than that, there is also more time, at least in recent history, there is an enormous political and academic willingness to push fiscal policy essentially to its limits. Its austerity is for all intents and purposes dead, at least for the time being. It is in vogue to suggest that fiscal spending is the solve of a lot of issues. We haven't quite moved to the world of full modern monetary theory and the idea that deficit doesn't matter at all. But I think some of what we're seeing, at least, is the pricing in that we might be getting a little bit into that world. And we can see that a little bit in terms of some of the pricing elements. For example, the New York Fed do a term premia breakdown, and that's suggesting that the term premia that investors require to be sort of compensated for holding essentially bond risk above that of just the expectations of where short rates will be in the future, that's increasing. And the Cleveland Fed do an inflation variant of that, where they themselves are suggesting that actually, if you look at survey data, the inflation, many economists and private market participants don't necessarily expect inflation to rise by all that much, but the uncertainty around that inflation has widened considerably, and people are demanding more premia for that. So I would say those are the kind of areas that I would put down to it.
Absolutely,
so or contributing.
So some really big sort of changes in the economic landscape there. And I think on this podcast, we've done episodes on the changing approach to fiscal policy, and perhaps we ourselves are part of this sort of mindset shift, which sees a much more active role for fiscal policy. But certainly that's part of what bond investors are incorporating through these market moves. So Luke, that's sort of, we've gone through the what has happened of the market moves, the why. So let's try and build a bit of an economic framework that explains how to think about these moves from the perspective of, say, a central bank. Lots of central banks are observing these market moves and having to decide if they are welcome, unwelcome, require some sort of monetary policy action to meet these moves or not. So what is that framework that central bankers use to approach bond market moves?
Sure, thanks, Paul. I guess at the highest level, the way to carve it up, to use a bit of economies, if I may, is people talk of endogenous and exogenous shocks. And sort of the idea there is endogenous relates to the specific internals of the economy itself, and exogenous sort of a shock to outside that system. To some extent, that distinction is a bit grey, because presumably you build a big enough model and pull in enough variables. If you really want to, you can endogenize, as it were, pretty much everything. But I guess what they have in mind there is the idea of variation in interest rates, which is due to variation in economic fundamentals. So interest rates moving because growth expectations are moving, the risks around growth expectations are moving, inflation expectations are moving, risks around that are moving, etc. And so that's endogenous. And exogenous would be, let's say you fixed those economic fundamentals, and with those given fixed economic fundamentals, any variation of interest rates you get on top of that, that would be exogenous. And I suppose a paradigmatic example of that, people often talk of a reaction function shift, right? And this is the idea that for any given state of the economy, the central bank might set interest rates differently to how it had in the past. So 2013, the taper tantrum is a great example of this, where we sort of had this exogenous shift, this sense that the Fed was actually going to set policy much tighter than we previously thought. And this led to a huge sell-off in bond markets, a big repricing of the expectation of what Fed policy would entail. And arguably, we're going through something vaguely similar at the moment. There is something endogenous about this move, in the sense that perhaps we're pricing in a reaction function shift that relates to the Fed's change in framework to this average inflation framework. So they are just going to be systematically somewhat more easy in policy than they were before, somewhat more accommodative of inflation than they were in the past. So that's a sort of a deliberate exogenous change from the central bank, which of course it welcomes if the market prices it. And then on top of that, if what's happening is interest rates are just moving to reflect economic fundamentals that are better, then again, I suspect they're relatively comfortable with that as well. But were it in fact to be an exogenous shock because, say, the market had misunderstood the Fed and thought that actually they were going to rapidly tighten in response to new worries about inflation, I think the Fed and other central banks will be much more concerned about that. And if it's exogenous in the sense that it's coming outside of your jurisdiction, in that, you know, the US is this monetary superpower, so interest rate movements in the US get transmitted across the whole world. And so you're seeing this big improvement in US fundamentals because they've had a $1.9 trillion fiscal stimulus. But if you're in Europe and you're getting those imported higher interest rates, but you're not getting the $1.9 trillion fiscal stimulus, then perhaps as the European Central Bank, you regard the move rather differently. So it really does matter what's causing these changes in interest rates, whether it's to do with a stronger economy and whether it's to do with coming outside of the system and outside of it in ways that you might feel uncomfortable with.
Brilliant. So that endogenous, exogenous breakdown is crucial because, as you say, it could be that endogenous moves they're justified by the improving fundamentals. They're broadly welcome as a reflection of the stronger outlook. Exogenous moves might be unwelcome or unhelpful because they are crimping, what otherwise might be a very nascent stage of the economic recovery. And it also sort of explains why different central banks, as you were hinting there, are thinking about this bond move differently. So where is the move endogenous and where is it exogenous?
So I think it's pretty clear for a lot of the reasons that Ross talked about, that a lot of what's going on in the US is endogenous in the way that I talked about it there. It is a repricing of the growth environment and risks around the growth environment on the basis of vaccine news, on the basis of huge fiscal stimulus. And that certainly explains why longer end rates have sold off more. So the curve has steepened in that way without, as Ross talked about, sort of the short end pricing in any tighter short-term interest rate policy, and to an extent that sort of average inflation targeting working. So in the US, that all feels relatively comfortable. But if you're sitting in Europe and you're seeing interest rates increase there, yields on various government bonds increase there, that feels rather more exogenous, right? That is moves being driven by their correlation structure with what's happening in the US rather than what's happening in the European economy itself, or anything that the European Central Bank is doing. And as you well know, Paul, and I'm sure you can speak to this better than me, but the European Central Bank has a framework at the moment which is entirely around keeping financing conditions favorable. And I think that is largely to try and push back against some of what we've seen.
Yeah, exactly. The favorable financing conditions mantra of the European Central Bank effectively means that it wants to keep bond yields low and anchored low, and hence it's tried to push back quite strongly, both verbally and more recently by increasing the pace of its asset purchases, pushing back on this increase in bond yields, which it essentially sees as an unhelpful spillover of the changing fiscal setup in the US. But Ross, another breakdown, another dichotomy, a comparison that I think matters in understanding bond market moves is whether they're orderly or disorderly. We often talk about disorderly market moves where markets gap or sort of move very suddenly in ways that are unwelcome. From your perspective as someone really in the nitty-gritty, the daily moves, the coalface of government bond markets, have these been orderly or disorderly moves this year?
Yeah, I think given the nature exactly of, as you just described there, of my role, there probably have been moves that are actually orderly, that have at times felt disorderly, given the speed of them. But I think really, if you look at a slightly longer term chart, rather than just intraday pricing, the reality is that an awful lot of the moves that we have seen, especially, I would say, very specifically in the large liquid markets of US treasuries, of bonds and other European bonds, as well as gilts, the moves have been pretty orderly, if not really entirely orderly. We have seen large day-on-day changes in yields, but these are not outwith of historical norms. We have been in an environment clearly post 2009 crisis of really since I was going to say the 1980s, bond yields have been decreasing, but we have had smaller and smaller yields, smaller and smaller moves on a sort of daily basis, given relatively low yield levels anyway. But we're not necessarily seeing anything that is outside that, even that post-crisis 2009 crisis sort of historical norms. Where there is a little bit of distinction is in a market like Australia, for example, which I think is a really good example of exogenous market factors that the central bank themselves would find or have found particularly unhelpful. And that's not to say that there aren't reasons that Australia 10-year bonds or Australian bonds in general should expect to be immune from the moves we've seen elsewhere. We know that the way in which the virus has been dealt with has been relatively more successful, in the Antipodean countries for a variety of reasons. I'm sure you can debate all day, but that's the reality there. And the positives in terms of vaccine rollout are still there and should still have a positive influence on those economies. But we have a central bank in the Reserve Bank of Australia that is explicitly targeting 25 basis points on 3-year bonds, and a yield curve control framework is also engaged in QE. And in February, we had absolutely enormous moves, specifically in the Australian market, so it underperformed the most of all developed markets, so more so than the US. And the day-on-day moves in the futures contract in particular were pretty significant. There's also a variety of technical reasons for why these things are in relatively smaller liquid markets. The impact of specific investor positioning, has a much greater influence on the marginal pricing. So we saw some of that, but we also saw the RBA having to, step in a rhetorical and a physical sense, buying more than expected in terms of their QE program in the short term to help calm bond markets, and re-emphasize their commitment to not just the yield curve control, but to the sort of overall QE program. So that's the closest things got, I would say, to disorderly was in the smaller markets. Australia specifically is an example of that. But overall, I think we are really seeing for a time being an orderly repricing. And another just thing to kind of emphasize that is, you've alluded to this, you both have, is that we haven't actually really seen this yield move feed through into financial conditions elsewhere. That is to say, risk markets are unbothered. Equity markets are, broadly unchanged, probably marginally higher, despite some rotation from some of the, tech names into other names that lagged. Credit markets have, by and large, ignored this move. So there are signs there that I would say that this has been pretty orderly so far.
Brilliant. So the purpose of sort of running through this framework, understanding endogenous versus exogenous bond market moves, understanding orderly versus disorderly moves, thinking about the impact, or whether it's been a headwind or a tailwind to other asset markets such as equities, is all that framework, all that background then helps us think about, well, what are central banks actually going to do or say about this? Are they going to push back on these moves, or are they fairly comfortable with them? And also, what does all this mean for the economic outlook? So Luke, let's get into that then. We've already established that there's a bit of a contrast between the likes of the US and, say, Europe or Australia, as Ross was talking about. What have been the key messages from, on the one hand, the Fed, and on the other hand, the central banks who've been less happy with these rate moves?
Sure. So, as I've sort of alluded to more or less explicitly already, I think the message from the Fed so far has been pretty sanguine about the whole thing. I would go so far as to say perhaps even somewhat relaxed about the move in long-term interest rates. At least there has been no significant sort of verbal interventions to try and push back on those. And I think the Fed does see it to some extent of vindication of pricing in its new framework, that this is precisely how it's meant to go, right? The policy rates are kept very low for now, that allows the economy to run hot, as it were, and that may push up market implied risks around long-term inflation, may change the risk profile, so that investors sort of need more compensation to hold the risk-free rate, precisely because they're less worried about the world, right? The reason that people might desperately want to hold the risk-free rate is because they're very, very worried about it, the world, that is. And as they get less concerned about the world, naturally that tends to lead to the risk premium they demand to hold that versus other assets that might be slightly higher returning to increase. I think where they would be slightly more concerned if we did start to see creeping expectations that they will start to hike interest rates earlier than they otherwise plan. For what it's worth, the Fed's current, people call them dots, the sort of the way they try and communicate their views about the possibility of where interest rate hikes are going to come, don't indicate any hikes before 2024. And I think they're probably okay with market pricing around now, but if those sort of expectations were brought any further forward, they would find some way to push back on that, I think. So it does sort of speak to the fact that, like, what happens to the curve sort of matters to the Fed as well. They're happy with the long end selling off much more than they're happy with the front end selling off, precisely because what that implies about the economic conditions and what their policy stance is going to be. I think the message from the Bank of England has also been relatively relaxed as well. Indeed, sort of the signaling from those guys since the start of this year has been broadly optimistic about the economic outlook given vaccine rollout, some noises that they are a bit more concerned about inflationary risks, and then they've sort of taken off the table a policy option they were flirting with for quite a long time, that is to go towards negative rates. So all three of those things feel like, if anything, welcoming slightly tighter financial conditions rather than pushing back on them. And then, as we've already discussed, I think the ECB, the European Central Bank, is in a completely different place, both rhetorically and as a matter of policy.
Brilliant. So, Ross, let's end then with what is effectively the $1 million question, which is, what do you think the next big move in bond yields is going to be? Is it for further rises in yields on the basis of a reopening economy and economic recovery, maybe higher inflation prospects, or is it actually that this rise is unsustainable and this super secular trend of ever lower bond yields is going to reassert itself?
Because this will be sort of recorded for posterity, I better sort of think long and hard about this answer. But I would say, on a longer term structural view, your second option is closer to what my own view is. That is to say, that I think a lot of the optimism around the sort of unwinding of secular structural dynamics that some market participants and commentators are calling for is overdone. That there is reason to believe, for a variety of reasons, one of the clearest ones being the sort of level of aggregate indebtedness has only increased in the economy overall, that we are quite sensitive as a global economy to the level of interest rates in a nominal and real sense. And that sensitivity has not diminished as a result of this crisis. So I say longer term, I believe that we are not out of this essentially downward trend that we have seen since the 1980s, essentially. However, I would say two things. From a very short-term perspective, as a market practitioner, it is difficult to identify a specific yield level at this point in time where optimism is fairly priced or cleanly priced, a level at which you'd be willing to say, yes, now is where I would buy. And the reason for that is essentially there is a huge amount of uncertainty and variability around the near-term inflation outlook. And the near-term just economic data outlook as well. We're talking about incredibly high nominal growth on a mechanical basis, fiscal policy coming through to push that up as well. Were we to see upside surprises in data, it would not surprise me at all if many market participants would ask themselves, why is the 10-year rate only at sub 2% in a world where we're growing, potentially 7-8+% nominal GDP. So in the short term, I think the uncertainty makes that longer term structural view a pretty poor risk reward one to put on right now. But my longer term view would be that is where you would want to position for. The other caveat I would have on that view is, and it's something I've touched upon, we've all touched upon here, is the fiscal outlook in the longer run. The more we move towards a world that is towards that MMT style philosophy of essentially the view that because the central bank has the right to print money and can control bond yields, that the fiscal limits we thought once were there don't really exist as you may have thought in conventional theory. The closer we get towards that world, the more nervous I would get about persistent inflation overshoot, just as fiscal policy, would be sort of increasing year on year. I don't think we're in that world quite yet, but that's something I'm sure you've discussed and continue to discuss, and something that's very much on my radar.
Brilliant, Ross. And I would encourage our listeners to go back and have a look at sort of episodes we've done in the past on inflation and the fat tails of the inflation distribution, on fiscal policy and changing attitudes to fiscal stimulus over time, to give a sort of sense of a lot of the background of these big macro market debates. But Ross and Luke, that's about all we have time for this week. Thank you both very much for joining us, and thank you for listening to Macro Matters. Just a reminder that we have a mailbox, macromatters@abrdnstandard.com. And we'd love to hear from you if you have questions or suggestions for the show. Then email us macromatters@abrdnstandard.com. Don't forget to like or subscribe on your podcast platform. But until next time, goodbye and good luck out there.
Please note that email is not a secure form of communication, so don't send any personal or sensitive information. This podcast is provided for general information only and assumes a certain level of knowledge of financial markets. It is provided for information purposes only and should not be considered as an offer, investment recommendation, or solicitation to deal in any of the investments or products mentioned herein, and does not constitute investment research. The views in this podcast are those of the contributors at the time of publication and do not necessarily reflect those of Aberdeen Standard Investments. The value of investments and the income from them can go down as well as up, and investors may get back less than the amount invested. Past performance is not a guide to future returns. Return projections are estimates and provide no guarantee of future results.